Hello everyone, Drew CPA here for Biz Mondays. I was just about to actually go riding. I'm actually still packing up. My bike is still in the back, and I'm scrolling through my text, and I saw this basically an interesting text. Someone made an investment and wanted to know what it was their ROI. So just thought I'll just do this quick video and then hit the trails up for a quick ride. So ROI is or stands for is an acronym that basically means return on investment. So what they were basically asking me was, how much money did they make on the deal that they just did? How much money they made? So I looked at the numbers they gave me. They basically put out $5,005, and the total amount that they received was $5,485. So just quick calculations, it looks as though they made about 9 to 10% on their investment. So how did I calculate that number? How did I calculate that return on investment? So first of all, let's talk about what an investment is. Investment is the amount that you're putting out. Okay, so, and this calculation, by the way, works on anything. Doesn't matter what you are investing in, this calculation works. So it could be stocks, could be, whatever asset you're buying, whatever it is that you're investing in, this calculation works. So your investment, the investment portion is the amount that you're putting out. So for the purpose of this video, we are going to make that $100, okay, $100. So that is the amount that you're going to be investing, $100. So that is what classifies as your investment. Now, to get what is returned on that number, we have to see two things: the total amount that is returned, or in the cases where just the amount that you made is returned, we're gonna have to do a few things. So if you are given the total amount that you if you are given the total amount from the transaction, meaning you've invested $100 and at the end they give you, say, $190, what you're going to do is you're going to take your initial investment and you're going to subtract that from the total amount. Okay, so $100 is your initial investment. You are given $190 back. You are going to take that $190 and you are going to subtract your initial investment from that $190. That leaves $90. You're going then to take you're going to then take that $90 and you're going to divide it by your investment. So it will be 90 divided by 100, which would be 90%. So 90% would be the return percentage on your investment. So if you're asked, what was the return on your investment? You could answer quickly, $90. Or if you want that to say that in percentage, you could say, I made 90% on that investment, 90% on that investment. So remember, quickly, take your investment, subtract it from the total amount that you received, and that number becomes the dollar amount that you get, the dollar amount that was returned on your initial investment. And of course, if you want to get a percentage, you just take that number and divide it by your initial investment amount, and that becomes the percentage amount of your return. So ROI, or return on investment, that is how it's calculated. Now, you could have invested and you did not make any money on the investment. So say, for example, you invested $100 and at the end of the period you were given $70. It means that you have to then take the $70 and minus that from your initial investment. You will be getting $30. So $30 would be the loss on your investment. And of course, if you wanted to figure out what the percentage is, you would take that $30 and divide that by your initial investment, and so you'll get the 30%. So $30 would be your loss, or 30%. So you can have a return on your investment, or you can have a loss on your investment. Either way, the calculation is quite simple, and it's something for you to definitely know how to do quickly. Definitely know how to do quickly, because as you're having conversations and you are given information, you can quickly ascertain, is this something I want to get involved in? Yes or no. Okay, for example, if I say to you, give me $100 and I'm going to give you $20 back on that $100 in the transactions that we're going to do. Okay, if you wanted to get a 30% return, you should know right off the bat. Okay, $20 over 100 is only 20%. So my 30% is not met. I'm not going to go with this deal. So ROI is a quick thing to calculate. It works for anything that you're investing in, and it's a good thing to know. All right, ROI, return on investment. Investments equal the initial amount outlaid or the sum of a series of amounts outlaid over a period of time. This includes any cost to produce the earnings or loss. Return, an amount obtained above the total investment, and all of this is to measure the investment's profitability. The initial investment for the purpose of this video is $100. If the total amount you receive is $190, then the ROI is $190 minus $100 or $90. The percentage is 90 or 100, and 90 times 100 equals 90%. Now, looking at it from a loss standpoint, the investment continues to be 100. The total ending amount is only 70, which means the loss is 70 minus the 100 or $30. The loss percentage would be 30 over 100 times 100, 30%. One disadvantage of the ROI is that it does not measure or account for the holding period. This means that if you're an investor and you're looking to really or truly compare investments, you should potentially use an analysis that factors in the holding period so that you can compare apples to apples. So, quick video. If you like what you're hearing, definitely hit the circle below and subscribe. Thank you for joining, and continue to watching our channel as we provide you with as much information, as much business information as possible. So thank you for watching.